Mike, I'm looking at your notes, and the thing that stands out to me here is that equity markets should not ignore and try and move past this bond situation that we have. It seems like you think the two are going to be still tied for a little bit.
I do. I think that the equity market has conveniently not ignored, but sort of set aside the interest rate environment for the past 6 months. And in the last 2 months, rates have climbed so steeply and so significantly that equity markets have been forced to pay attention. And when the Fed made their latest decision known on Wednesday, the equity market interpreted the statement and the press conference as extremely bullish and dovish for 2 to 3 years. And they went into risk on mode, but the bond market did not react that way. The bond market, yields came down a little bit intraday, but bond yields were still higher day over day after the Fed announcement. And then what we're seeing now is a climbing of hiking of rates by the market, even since that statement release. And equities are stuck because the bond market is signaling that they do not agree with what the Fed forecast and what the Fed said. Now, whether they're right or the Fed is right, it doesn't matter. The bond market is in conflict with the Fed, and that's bad news for the equity market, because when there are big collisions on the horizon and the bond market versus the Fed is about as big as you can get, there's going to be collateral damage, and the equity market is going to suffer. And some equity investors, I think, are smelling that, and some are just whistling past the graveyard. If the rates climb another 10 or 20 basis points, I don't see how any stock, maybe the bank stocks, can climb. Everything else has got to come down. So I don't want to say that the sky is falling. I mean, I've been accused of being too risk averse for too long, and I understand that. But there are inflection points that I fear are very close, and the go stock attitude of last year and before the pandemic, I think that's in jeopardy.
Where do you get the levels, Mike? Is it a level, a magnitude that makes a difference? Bank of America wrote 1.75%. Others have said 2%. Others have said forget the actual level. It's the rate of change. And so far, of course, coming off a zero bound, we have nothing in history that is a doubling of the 10-year yield. No matter how small it may be, of course, it's still a doubling, and we have no precedent for that. So walk me through how we should gauge, where the pain point is, and also then, of course, that begs the question, well, when does the market calibrate towards whatever level that we're trading at in the 10-year yield? Or maybe the market can't calibrate if it just keeps going up.
That's a good question. I don't think that there's an absolute number that is the make or break level for bullishness or bearishness in the stock market. I think right now the better game to play is the relative rate game. So if you look at rates over the last 2 months, the 5-year to 30-year range of the yield curve is up about 50 basis points. That's 2 Fed hikes that the market is doing, not the Fed. And that matters. That is an economic break, whether the equity investors believe it or not, and that is a relative change to the environment that we had back in January. Now, can we handle another 25 basis points of market hiking? I don't think so, not at these valuations. But can we hang out if the interest rates stabilize here? Probably. Can we rally if interest rates drop 25 basis points? Absolutely. So my answer to your question is not so much 1.75 is the magic number or 2 is the magic number. It's let's just take stock of where we are right now and let's decide whether 25 basis points higher yield is bullish or bearish for stocks. I think it's bearish.
Now,
and if 25 basis points come off of the yield curve, then that's probably bullish. I would basically say, let's pretend that we are in balance right now. And if rates climb, you should sell stocks. And if rates fall, maybe you should add to stocks.
Is there a point where, Mike, we can wash off enough froth from the market, and particularly the long duration assets that have been very tied to bonds, obviously tech and growthier stocks? I mean, some of these are 20, 30% off their highs. Everyone's favorite Tesla sitting over 20%, more than 20% off the highs, and it's going to be down again this morning. Is there a certain point where we've kind of cleared the froth, or is that going to be a fool's errand trying to assess that when we are coming off record valuations even higher than .com by almost every measure in the month of February?
Working off the froth would be good. The healthy way to do that is for earnings growth of those highly valued companies to blow the expectations out of the water. Now that's possible, but those expectations are so high that we need to work those valuations down, and there's two ways to do it. You can have awesome upside surprises in the results of the corporate sales and earnings, or you can have a price decline in the market. And I think the best case scenario is that prices stabilize and these companies just shock us with how good their results are. And then they up their guidance to the street from there. And then, we can be comfortable with these valuations. If we look at Tesla, not that I know much about Tesla, but if Tesla blows the numbers out of the water and says, our guidance is even better than last time we spoke to the street, well, then I think that would preserve the high level of confidence that investors have in Tesla's growth story. And you could say the same thing about Microsoft or Apple or, Zoom or any sort of high valuation name out there. So working off the froth is exactly what I think is necessary to take the risk out of the environment. And if you're going to work off the froth with corporate results, it's going to take a quarter or two. If you're going to work off the froth just through market forces, you're looking at, I don't want to call them nasty, but significant declines in the price of these high valuation assets.
Mike, one of the things I'm wondering here is the case for stocks. Does one have to, if we're in the process of wiping off the froth via higher yields, and there's not an obvious way for yields to turn around right now, it just going off the price action. If you have some view about the economy, maybe then you think yields are too far. But just judging from the price action right now, don't fight the trend. Not my job to try and say the trend will end. So I assume that yields keep climbing. So then if I assume that yields keep climbing from here, and that's going to apply pressure to stocks, then does one have to have a view on when the Fed will alter and either change the buying program or a twisting program? Does one have to be like a J. Powell mind reader to know when enough pain in equities will tighten the economy to get his attention? Do we have any idea where that might be, that level of pain, and how far down maybe that is in the S&P 500?
That's a very astute point, and I think you're 100% correct. You, me, everyone in the equity space right now is playing the Fed watch game, whether they know it or not. And the bond market is telling the Fed that the Fed needs to contemplate hiking sooner than they're telegraphing. And a fight is brewing. If the Treasury market keeps lifting rates, which was the premise of this conversation, equities are going to buckle. And at some point, the pain will be so great that the Fed has to step in. The Fed watches the market, not because they care so much about small moves or valuation levels, but they watch the market for big signals that indicate to them that maybe they're on the wrong path. Maybe they should contemplate some change of their policy. So by the time the Fed comes to the rescue, if you will, whatever that means, equities will have suffered a 10 to 20% decline, and that's what we want to avoid. So if you want to figure out when to sell and when to buy, you have to be well in advance of both situations. So I would say now's a good time to trim some equity risk and then once the pain in the equity market shows up, you buy in anticipation of the Fed coming to the rescue, because the Fed will come to the rescue at some point when things get too crazy. Let's just use that word for lack of a better description. The Fed is going to take even more powerful steps to control yields. Maybe that's yield curve control. Maybe that's just a new round of huge QE. I don't know. And when that happens, that's going to be incredibly bullish for stocks.
Okay. When?
So when? Boy, when? That's a good question. Okay, let's go back to the start of our dialogue. The market has hiked rates 50 bips, let's just say, over the last 2 months. I think if the market hikes rates another another 50 basis points, so that we have essentially 1% of hike that has been market implemented. And if that happens before June, I'm making a judgment call. I think equities buckle, and I think the Fed pays attention.